Hey, everybody. Welcome back to Tax Tuesdays, bringing tax knowledge to the masses. Just in case for anybody here for their first time, we do offer this free on YouTube, right?
Absolutely.
Every other week, submit your questions. We'll answer them for free. Of course, we want you to become a tax client, learn about our services, all that stuff, but do this every 2 weeks. Submit your questions. We go over your questions, whether you're a client or not, every 2 weeks. So welcome to Tax Tuesdays. My name is Barley Bowler. I'm one of the CPAs and tax advisors here, joined by Mr. Elliot Thomas.
Nope.
He's the manager of our he's a little shy right now.
No.
Manager of our tax advising department. Very happy to have you guys here. Hey, and again, for anyone here for their first time, welcome. Very happy you're here. We're going to go over your questions. You submit your questions. We go over them live every 2 weeks. We've got a chat feature here. We've got a Q&A feature here. Please post your questions. Shout us out in the chat where you're from. And while everyone's trickling in here, just want to tell you guys a quick little story.
Yeah.
No, I'm just kidding. I just want to give you guys a little bit, one quick minute on my background. Toby used to do this every other week. We have Amanda Winalda, the head of our Land Trust and Deeds Department, doing this with us as well. Elliot doing this as well. Just want to give you guys a quick bit of background on me. I'm originally from Montana, Missoula, Montana. That's where I got my accounting degree originally, plus did my master's degree there in business. I had a small MBA program, tons of experience working with business owners. Just really, that's what really turned me on to working with entrepreneurs, family-held, closely held corporations. That small business success story is really what kind of got me hooked on this whole tax planning, business planning, seeing your successes, avoiding overpaying taxes, avoiding audit, right? I used to work in audit. I was that guy. I was this kind of scary guy that showed up and everyone thought their birthday was getting taken away, right? When we dig into the records and tell people what they're doing wrong. So I really kind of take a distinct pleasure in helping you guys avoid audits, avoid paying so much tax, right? So that's part of what I'm trying to bring here today as we go through the tax stuff. I worked in, like I just mentioned, I worked in audit, government audits. I audited a bank, audited a fleet of Ferraris in Beverly Hills. That was an interesting job. Kind of have some fun stories on that one. Let me know if you got any questions about that. So audit services, it's just very, very convoluted. It's a look back process, right? You're just looking back into the past. And again, I was just way more interested in the business planning with entrepreneurs, looking forward, projecting financials, estimating financials, all that kind of stuff. So very happy to be here at ABA. Well, that's what I do here. When I applied for this job, I noticed the focus was on bookkeeping, tax planning, structural stuff, right? Having you run your business with our help, as opposed to just turning it over to somebody and not really knowing what's going on. So just a little bit of background on me, guys. Very happy to be here. Again, my name is Barley. I'm a CPA here in the state of Nevada, tax advisor here, background in business. I love working with you guys. A lot of you guys I've met. And again, for anyone here for their first time, welcome. We do this every 2 weeks.
Yes, we do.
Free tax knowledge to the masses. That said, we probably got a couple announcements here or bullets we want to hit.
We do. And I'm pretty sure we see what.
Oh, here I got them.
Yep.
I got them. Live Q&A feature, guys. Shout out your questions as we go. Plus the chat. Shout us out. Let us know where you're tuning in from, where you're listening in from. What else? If you need a detailed response, we're going to give you a link to set up a tax consult. You can do that today. If you need a more detailed response, tax planning, crunching the numbers, etc., we'll encourage you to become a client. We're going to give you a link for that in just a moment. Fast, fun, educational. Again, this is a free service. We just put this out every 2 weeks to just kind of plant these seeds, give you this information. A lot of this tax stuff is kind of overwhelming, so we're just going to chip away at it every 2 weeks, go over the basics.
Yeah, send those questions in. I look over every question, get as many as I can in for us to have during the show, but really enjoy it. And I thank you all for sending those in. It's a real pleasure to have the opportunity to read all your questions, and some more than others.
We get some good ones.
Yeah.
Some very challenging ones, plus some basic ones, plus the one we've just flat out never even seen or heard before.
Yeah.
Those are always fun.
Yep.
So yeah, let's hop right in. We're going to run through the questions, guys. And then we'll dive right in. So how can I take advantage of tax code 179, section 179 expense deduction?
Yes.
That's a big one.
Yes, it is. A lot going on there. If I have more business items to buy, like a desk, should I buy them before the end of the year, or maybe I wait to the new year? When do I buy these things?
Right, fiscal tax planning. One, invest in an equipment leasing investment, in 2025. so in the current year, and it's active and writes off 100% of the equipment cost in 2025, but then in 2026, no longer active. We're talking about passive versus active, right? Does the income revert to passive income, or is it still active for 2026? Great question.
Can I still take the IRS Mark-to-Market Election for the year of the tax year starting January 1st, 2026?
Wow, I'd get nervous making that election, but we're going to go over that for sure. I have a solo 401k, required minimum distributions coming up due here in 2025. First of all, how does this work? And can I make qualified charitable distributions from my solo 401k? We're going to iron out those details. Plus, do these tax-free distributions go on my 1040 as a deduction? Not quite, but we're going to cover that.
Is there a cap on how much money I can withdraw per year from my traditional IRA to purchase an income-producing rental property? What are the things I need to consider before making this decision? I'm 55 years old, and I am aware of the 10% penalty.
Okay.
Cover some of that detail.
Is there an annual cap on bonus depreciation related to the tax deduction? So is there a limit on how much bonus depreciation we can take? Kinda.
Can I do a cost segregation study on a property that's in a qualified opportunity zone fund? How does this impact the capital gains tax deferral that ends in December of 2026?
Some fun timeline details.
Yeah.
We can go over there. Qualified opportunity zone fund. Finally, can I do a 1031 exchange related here for a property in the qualified opportunity zone, the QOZ, and avoid the tax due when the deferred tax comes due in 2026? We'll talk about those details as well.
Who's this guy?
In the meantime, go ahead and subscribe to these two characters' pages. We got Clint covering, as you guys mostly know, asset protection. Clint and Toby, both tax attorneys, right? Clint obviously focuses more on the asset protection side. Toby more on the tax planning and mitigation side there. Subscribe, tons of great content. As most of you know, you're on YouTube. Go click subscribe. Check out the most recent videos. Toby it's not on here, but he just did another recap on the OBBB. How many B's? The new bill. He just did a recap on the new bill. So check that out. Plus, we got some events coming up.
We do. We have a live one in Dallas. So if you're in town, only $49. So scan the box there and get some details.
Yeah, if you're in Dallas, come see us. You're gonna be there, right? Maybe.
It's looking that way. Yeah, I think so.
Nice. Come meet Elliot. Talk tax. Corner him in there. Ask him your tax questions. And more live events, couple virtual. Obviously, the one in the middle there, the Dallas event in December is a live event, but we also have these virtual events as well, tax and asset protection workshops. Got one of those coming up real soon.
Yes, we do.
And then another one in December.
Yep.
All right.
I think that this weekend, I believe.
Yeah, if you need more information on those guys, shout us out in the Q&A. You want more information on the events. And as promised, scan this QR code. If you have tax questions and you're ready to get the ball rolling and take a bite out of this and just really try to take on this tax planning effort, this is a great place to start. We offer the legal and tax planning service kind of combined. Start here, scan the code, ask your initial questions, see if it's right for you. We can take it from there. Ready to wrap?
I'm ready.
All right.
Do it.
So first question, how can I take advantage of tax code section 179? We're talking about the section 179 expense deduction. Very popular, especially was popular as bonus depreciation phased out or phased down, right? Recall it was 100% bonus for a while, then it was going to 80, 60. I think this year we would have been 40, right? 40. So, but we're back up to 100%. So section 179, not going to be as much of a play here, but we still want to be very aware of what this is and how it benefits us, right?
Yeah, it's been around forever. And just as Barley pointed out, we have these two different concepts. 179 just says that if you have business equipment, or at least it's being used over 50% for business, then you can deduct whatever percentage of use is immediately that year. Bonus depreciation does kind of the same thing. Right now, it's 100% bonus depreciation. So for equipment, a lot of the equipment, you can, again, take immediately 100% bonus depreciation deduction. So why is one better than the other? It's really kind of an overlap, and that's true to some degree. 179 does have some limitations, though. First of all, you cannot use it to create a loss. So if you had $200,000 of equipment to deduct under 179, all of it qualifying equipment, but you only had 150,000 of income, you're just going to level off there and wipe out the income with an extra 50,000. It doesn't go away, just pick it up next year. So that's one big difference. Whereas bonus depreciation can create a loss, and many times does when you take enough of it. So that's kind of the difference between the two. But how can you take advantage of 179? Well, you just need to have a profitable business and incur these expenses on qualified equipment, which is just about any business equipment.
Right.
There are a few exceptions, and especially in our area that we specialize in with the real estate. Yeah. We were talking about this earlier, and if you have a commercial rental building, well, then you can use 179 quite freely, like for HVAC items and improvements and things like that. However, if it's just a rental building, well, then maybe we can't use 179 for, let's say, an HVAC. That's kind of common.
Commercial versus residential. Yeah. Single family resident. They just treat it differently. The HVAC is considered part of the structure. It's not with the residential. It gets pretty hairy there. But with Section 179 in commercial building, a lot of use there.
Yes, exactly. And another popular one that breakout, what we can't use 179 for would be alarm equipment, fire and safety type equipment. For some reason, those are just not allowed. I couldn't really tell you why. They're just written out, and they have been for some time under the 179. So, but nonetheless, that's kind of a difference between the 179 and the bonus depreciation that we've seen so far.
Yeah, so profitable in the business, you have net income there, can't create a loss. So that's pretty easy. There's no really additional limitations on top of that. It just can't create a loss. But we're going to go over this in more in a moment, but you can pair these two together. This is very important. I'm just going to kind of leave it there. Bonus depreciation, Section 168K, and expense deduction, Section 179, can be combined. And pretty much our software kind of automatically does that.
Oh, yeah, it does. Well, I mean, it's by judging. You do have to make an election to do it. So we kind of do it on our own as far as tax preparation. However, one thing that I would say that, from a strategy standpoint, maybe you don't want to create a net operating loss. And there is when we get into the bonus depreciation, you have to really do it's all or nothing, at least within that class. If you have 5-year property and taking bonus depreciation, then you have to do it with all of it that you purchased that year. 179, you don't. In fact, in one particular asset, whatever it be, maybe you got a new crane or something like that for your construction company, you can choose to only deduct so much of it. Let's say it was 250,000. Well, you may only want to deduct 200,000, and then you can hold off on the other 50, or just do straight line depreciation on the other 50. So that is an advantage if there's a case where you don't want to create a loss, whereas maybe bonus depreciation in your particular scenario will create too much of a loss. Toby talks about that a lot, not having too much of a loss in a business, or at least not showing enough profit, because that can affect a lot of lending and things like that and other financial credibility issues. So that would be one situation where maybe you'd want to do 179 as opposed to the bonus.
Yep. Great question. Let us know if you got any follow-up on that, guys. So kind of tagging onto that, if I have more business items to buy, like a desk is the example given here, should I buy them before the end of the year or wait until the end of the year? I love this question because it really just gets to the root of this tax planning issue of timing, right? We got cash flows and we've got timing. That's going to be a very important. So obviously, if I buy it this year in 2025, I'm a cash basis taxpayer. I'm going to take the deduction in 2025. Maybe I didn't have any income. Maybe I just got started. And in 2026, I'm anticipating being very profitable. It might be better to take that deduction in 2026. I really like this because this is where we get a little bit of opportunity, a little bit of freedom to have some control over how much tax we're paying. We don't have to purchase the asset now. We don't have to purchase it next year. We have the choice, right? And anytime we have a choice, that's usually a good thing, especially in taxes. So we can look at your cash flows, look at your kind of project your income, where you think you're going to land at the end of the year, see which year it's going to be more beneficial. Now, if you need a desk, buy a desk, right? But for tax planning purposes, that December 31st cutoff is going to be your main date there.
Yeah, it is, and that's the real issue. What if you've done tax planning and you know how much income you have? Do you want to have an extra deduction before or on this year or in the next year? That's really what it all comes down to. You're still going to have the same deduction either year. It's just a matter of if you think you have more income and you need a deduction this year versus the next year would be your choice. But whatever it is, we want to make sure that you have the transaction completed. So if you wanted to get it in 25, make sure you have the actual purchase and place in the service of that asset, and then you can get that deduction. Because if you don't, maybe, if you're not cash, following cash basis, and then you're trying to, deduct it or buy
Yeah.
it next year for this year, that's not going to work. So just be aware of that. We run into that quite a bit.
That's a really good point. Like you buy a pizza oven or something like that, you can't just purchase it. You're gonna have to freight, installment, calibration, right? All these things are gonna take time.
Oh yeah, yeah. We run into this a lot with some of our other reimbursements, especially on S&C corporations, such as our 280A, our
Mhm.
accountable plan reimbursements, administrative office being one of those,
Right.
medical
Timing.
reimbursement. How many times do we hear, well, I incurred these expenses and I even turned them into the C Corp, but the C Corp never cut me a check and paid me back.
Yeah.
If it didn't cut it back, well, then there's no deduction there for the C corporation. Ergo, there's no, the corporation's not going to be able to take advantage of that till next year. And so in the next year on your return, you're going to have inflated numbers really, because you probably incur some of those expenses again in the 2026 year. Not that it'll be an audit risk necessarily, but it's something that, is going to be kind of off-putting. If you had income in 25 that you want on your C corporation, you wanted to incur that deduction, but you didn't reimburse yourself. That's probably the most common thing we run into at this time of the year. I'd say, make sure that you get that reimbursement in and you get that check cut.
Mhm. Yeah, absolutely. Any questions we need to hit?
No, I think that's
Good.
it.
All right.
Cool.
All right. What's this?
The big one. If one invests in an equipment leasing investment in 2025
Okay.
and is active and writes up 100% of the equipment costs in 25,
Nice.
and then in 26 is no longer active, does the income revert to passive income, or is it still considered to be active for 2026? A lot going on in here.
Mhm.
And the concept really, I think the bigger concepts here are really the passive versus active.
Yep.
And this goes for any business out there. I don't care what the business is. The code has a special provision, 469, and it just says, look, if you're running a regular business outside of long-term rentals, you need to materially participate. If you don't, it's passive. Why do we care? If we have a passive activity, and maybe some of our passive activities create a loss for whatever reason. Maybe we bought that desk in time. Maybe we did bonus depreciation, create a lot of passive loss in our business. We can only take those passive losses and subtract them against other passive income. It's not going to offset our W-2 income or anything else that's ordinary income. So that's something we have to watch out for. And that's the difference between that. Now, if it's active, if we materially participate, make it active, then it will allow us to deduct that cost against any income on our return. Material participation test, we talk about all the time.
Yep.
It's got 7 different parts to it, some more relevant than others. The most common, basically, if you put over 100 hours and more than anybody else in that particular business, or if you put over 500 hours, but to be sure, there are other tests. Like if you were in the previous years, you were maybe, it was active for you 5 of the last 10 years. We don't talk about that one a lot. And there's other tests like that.
Mhm.
But getting straight to our question here, we have equipment leasing investment. Now, this is something that's out there. This is an investment I've heard about a couple of times recently. And the concept is Barley's had a big successful year. He's got a lot of extra cash. He wants to invest $500,000 maybe into something that's going to give him a deduction. So he hears about this equipment and leasing investment plan, puts the $500,000 in there. Now, he put 500 cash in, but they can extend him credit on that and allow him to buy equipment for his business for say $2 million worth. And because of that he owns that equipment worth $2 million, now he can take substantial deductions on his business. But he has to be actively and materially participating in that business. Well, usually in some of these investments, really Barley's not doing a lot. He's just maybe overseeing some stuff, but behind the scenes, these companies or these investment groups are really doing all the work for him. And now we get into a problem. If they're doing all the real work, making sure he owns these equipment things that are being leased out to the general public.
How are you going to pass that material
Right.
participation test?
At best, maybe you're telling them what city to go to, maybe, and maybe you're telling whether or not to lease it that week or not. But there's not, most of the heavy decision making is being done by someone else. That becomes a potential problem. So just as you asked, I mean, how are you going to prove that?
Right. Yeah, well, we started our conversation earlier.
Exactly.
Yeah, that was my question. How do you even show that you material, like if you have a syndication or something like that, or a bunch of owners, how do you even show that you're participating in that?
Yeah, it's tough. I mean, what's he going to do? So it's a kind of a tough investment. So I just say be careful out there and make sure you know what you're getting into. You got to materially participate. How are we going to tell? How are we going to show that Barley materially participated in that? Now, if he actually took on the equipment and leased it out himself, well, that might be. But if he's allowing someone else to do the investing for him and pushing it around the country and determining where it goes and things like that, that's not really all that active.
Mhm.
Yeah, I
Yeah,
think
I was gonna say we could change the fact pattern just slightly if one invests in an equipment leasing business.
hold it. Yeah.
Right, and that would simplify it in our terms. But to directly answer your question, if we have active participation in year one, take some losses, get some income, it's active income, active loss, and then you have somebody else manage it in year two, you'll be considered a passive investor. Any losses incurred from that point would be considered passive. But the active losses you already incurred in year one, they're kind of locked in, so to speak. You've already taken that deduction. They're not going to take it away from you in year two just because you're not managing the property anymore. It'll just change the income and loss characteristics moving forward.
Yeah, and that's typically the case here. We had a really nice isolated situation where we had just 2 years, 25, 26.
Mhm.
Like I said earlier, if you have more activity going on, you've been in this business for a long time and many, many, many years you've been active, and then all of a sudden you change to passive because you just didn't do as much, it still might be a materially participation for you just because of some of those tests that say 5 out of the last 10 years or something like that, that you've been materially participating. So just be aware of that. But in this isolated situation, only 2 years, exactly as Barley said, we were active 1 year, no problem, provided we materially participated. And then in 26, you can go ahead and go passive, but it's a whole different, it doesn't have any impact on what happened in 2025. That's only going to be what happened in 2026 as far as incomes and expenses to determine the real impact of being passive.
And we're going to change gears a little bit here in just a sec, but I just want to note that a lot of you kind of are like, well, this reminds me of something I talk about a lot. We talk about a lot here at Anderson, buying a short-term rental, right? You actively manage it, materially participate in the short-term rental for the first year, do a cost segregation study. Those losses are active losses if you materially participate, right? In year two, you turn that over to a property manager, right? Keep the same short-term rental status, turn it over to a property manager. Any incurred income or loss from that point will be passive, but these big deductions you took in year one will remain active. They've already been taken. Yep, they're locked in. So I know that a lot of you were out there thinking about, I could do that with a short-term rental. You're exactly right.
But just remember, you got to do the work.
Yep.
Okay, not other employees that are outside of your
Material participation. It's
Yep.
an individual. Yeah, you can't have employees doing it. You and a spouse can share responsibilities there, but no other employees. Don't want your kids doing it necessarily either.
Yep. Great
Great.
question. Lot in here, a lot of depth here
Right.
that doesn't really hit us at the surface. That's why it's deep, Elliot.
Right. Yeah, it's not on the surface. Great. Any questions before we change gears on
No,
this
we're
here?
good to
Okay,
go.
great. So, IRS mark-to-market election. What the heck is this, Elliot?
Yeah, a lot going on here too. So
And is this the same thing as trader status or
well,
active trader status?
mark to market's coming now. We're talking about trading stocks. Okay. So let's just start there. And you can have your regular account where you just don't really do a whole lot. It's just basic trading or something of that nature. And then you can be more active where it's really your day-to-day job, substantive, continuous trading and things of that nature. And that could be trader status. IRS has a lot of different, it's kind of a moving target. We don't recommend it, but you can get there. One of the reasons people want to get to that status of being active trading is because they can make this election that we're referring to mark-to-market election. And what that means is that we go to the end of the year, let's say December 31st, and we look at all that Barley's been doing in his trading. And if he had a lot of gains, but he hasn't sold them yet, this is the trick. He hasn't sold them, or maybe he had a lot of losses. It really doesn't matter. At the end of the year, you just look at where it's at.
Unrealized gains.
Exactly. Exactly. You add them up and act like he did sell that day at midnight, December 31st, and went ahead and recognized all those. Of course, he didn't, though. And so what happens is if people have a lot of losses, they like to use this strategy. Well, that begs, why are you trading if you have a heavy amount of losses that you feel so encumbered that you must or can't get by if you're not trader status, because it's an audit risk, I tell you that. But anyway, when you make the mark-to-market election, and you have those losses, you could take them immediately against any other income on your return. And that's nice. We understand that benefit. However, what happens down the line, if you took a loss, maybe we want to draw this out, how the basis works. Let's say, again, we have $100 that Barley's
as our stock.
Yeah, he bought it for $100. So that's his basis right now. Now, at December 31st, let's say the value is $80. Okay, so it's gone down. He has a little bit of loss, but he hasn't traded it yet. So normally he wouldn't recognize that. It just wouldn't show on his portfolio. But if you do that mark to market, well, now he can take $20. He has a $20 loss there theoretically, and we act as if he sold it. And so now he has a $20 loss on his return that he can take. And some people find benefit. Now that 20 then actually goes to reduce the basis of the 100. So he recognizes the deduction of the loss now, excuse me, then the 20 goes to add to basis. So he's going to have 120 later on. That way he can't duplicate a loss when he finally does sell in future years. Opposite of that, let's say that it's now at 120 at the end of the year. If you want to change that to 120.
Oh, to gain?
Yep. If we have a gain at the end of the year of 120, or excuse me, the price is 120 at the end of the year, then we have a $20 gain, and he'd have to pay tax on that. So it's the same thing at 1231. He's going to have to recognize that. And again, that would impact the basis so that he can't duplicate or double dip on that. And that would be handled in future years when he finally does sell the stock. So that's what's going on here. We want to recognize that gain if you're taking this mark-to-market election. The problem is that to do that, the IRS says, well, you have to do it on last year's return. So back to our question, can I take this on January 1st for 2026? Well, this particular taxpayer has to go back to their 2024 return, the previous year's return, or for 2025, excuse me, and make the election when they do their 2025 return. So as long as they make that for the year 2026, as long as they make it before April 15th, when their 2025 return is due, then they can. And that election is a statement that you have to put onto your return and send it in with your return saying, hey, I elect trader status, and I am trader status, and I'm electing the mark-to-market election. And as long as you have all that for the 2025 tax year, and we do it before we turn in our tax returns for 2025, which are going to be April 15th of 2026, then yes, we could do that. We don't recommend it though, because when you get into this status, this trader status, typically all the income and the deductions, it's all going to show up usually on Schedule D for capital gains and losses.
The income, not the deductions.
Correct.
Right.
Yeah, all the losses, excuse me. Yeah, all the losses. But all the deductions from business-related expenses that maybe were incurred, those are going to go on Schedule C.
Ooh, audit risk, right?
Right. If we ever heard anything from learned anything
just
about
go a loss year after year after year.
Year after year after year, constant loss.
Yeah.
And that loss is heavy, heavy audit risk. So we really never recommend the trader status. We don't do returns for it. So we don't recommend you do it. But that wasn't the question. The question was on January 1st of 26, going forward in 26, can I be, a trader and can I make an election for this mark-to-market election? Yes, you can for 2025, as long as you, excuse me, for 2026, as long as you do it before you turn in your 2025 return without extension on April 15th.
So as if the election wasn't complicated, the timeline for the election is complicating. But what's easy to understand is that if you make this election, your unrealized gains become part of your taxable income or loss at the end of the year. And that makes me nervous. I mean, I love that, if you had a big loss in stock this year, you get to take an active loss. But then what happens next year? What if you have a great year stock trading? You have a large gain that you didn't sell. You're going to owe tax on that gain at the end of the year, even if you didn't sell it. It can kind of be a nasty surprise.
You're only punishing yourself for doing well in trading stock by using this. Because if you, just as you pointed out, if you have a heavy gain, it made $1 million of that you haven't sold yet.
Yeah.
Where are you going to pay the tax on?
Right.
Where are you going to get the cash? You're going to have to sell anyway.
Yeah.
So why go through all this? Why go through the audit risk? We just don't recommend it.
And I think that should be reiterated again. We don't prepare returns for people to make this election. Just get that to tell you kind of what we feel about it as a company. And Toby knows this stuff pretty well.
Yeah, a little bit.
Yeah, he knows this stuff inside and out. It's not like we couldn't do the returns, right? It's causes some trouble.
We don't need the headache.
That said, for those of you guys that are doing this and know what the heck you're doing, you keep running with it. All right.
Yeah.
There's some people that just this is their niche and they do this but for our guidance here and now, that's what we would recommend. Steer clear.
Yes, absolutely.
All right, moving on. Make sure you subscribe, YouTube channels. Again, just a great free source of information. You don't have to be a client. Tons of great content on here. Captains of industry, industry leaders, CFOs, CEOs, bankers, all the above. Toby's got a great network and shares that freely with all of us. Same with Clint, asset protection. So much good content on here. I think Toby's winning the we got over 1.1 videos.
1,100.
Cleared the 1,000 mark pretty easy there. Make sure you subscribe though. Great content. And again, scan this QR code. You can talk to one of us, do tax consulting, tax advising, tax planning. Scan this code. You can just set that up right now. And just to remind you guys, we do focus on real estate, small business. We focus on stock trading as well, but we have kind of a separate trade structure. We don't recommend mark to market, but we've got a great way to reduce your capital gains on that. So that's kind of our area of focus, real estate, small business, stocks, real estate being number one. Let us know. Scan that code. We can talk. And come to the event in Dallas. Another link here. Just make sure you scan this QR code if you missed it the first time. Got a live event coming up in Dallas, December 4th through the 6th. Love to see you guys there.
$49.
That's right.
Best spent ever.
Scan the code and show up. Dallas is going to be beautiful in December. All that humidity should be all died down. All right. Look forward to seeing you guys there. So solo 401k. Talk about this a lot. We got a lot of closely held, family held corporations.
Yeah, get a little bit of a retirement plan going on.
Solo 401k is a great way to do this. I have a solo 401k. Excellent. Also have required minimum distributions, RMDs, coming due here in 2025. Can I make a qualified charitable distribution from my solo 401k? Great question. Do these tax-free distributions go on my 1040 as a deduction? What do you think?
Well, I think first of all, we probably better say what a required minimum distribution.
Let's define some terms.
Yeah.
Good idea.
RMD, required minimum distribution, it just says at some point, you got to start taking money out of your retirement account. For a solo, it's typically 73 years old. Then we start taking the RMDs, and that's going to be taxable income. Qualified charitable distribution, however, is a concept where from a retirement plan, your RMD that was going to come out, go ahead and send it into a charity. I don't want it, give it to a charity.
Never even comes to me.
Exactly. Right. Never even touch it, hands off. When we do that, it never touches a 1040. If it never touches a 1040, it's never income on the 1040 or a deduction. It just didn't exist, and you just didn't get penalized by having that income come to your return. But you cannot receive it. It has to go from the plan operator sponsor over to the charitable entity
qualified
itself.
charity. Yeah.
Exactly. However, we're asking about solo 401k here, and you can't do this for a solo 401k. You can only do this for an IRA. So we have a little bit of a confusion going on here. Only IRAs are eligible for these qualified charitable distributions.
Yeah. So individual retirement account versus like a company sponsored plan.
Exactly. So we're not able to do it here with the solo 401k. But all the other pieces really are active here. If we had an IRA, had a required RMD coming our way, well, then we could up to approximately 108,000, I believe is what it is for 2025. You can put that in, excuse me, you can't, but whoever's handling your IRA would put it directly into, donate it to the qualified charity. And that way it never again hits your return. No income, no deduction, but you don't have the income showing up, no tax on it.
Wow, okay. So solo 401k, a lot of you guys have these, just FYI there. Our RMDs are required, but charitable contributions only from the IRA. Okay.
Yep. And you cannot touch the cash.
Right.
That's the important thing.
Right. Or it's taxable to you instantly. And right, if you do the math on it, let's say I take the required minimum distribution, it's taxed to me, and then I donate it to a charity and take a deduction, you still end up with some taxable income. Right, that's the whole point of this. We have a good income stream. I don't need the money. I just want to put this to my charity and kind of avoid the tax headache, and that's a great option there.
Yep.
All right. What do we got here? Oh, kind of similar. Elliot does great with this, guys. He reads all these questions, guys, to put them in a good flow order, which is not easy when we're talking about taxes, but
Is,
on with the conversation here.
is there a cap on how much money I can withdraw per year from my traditional IRA to purchase an income producing rental property? What are the things I need to consider before making this decision? I am 55 years old and I am aware of the 10% penalty. Again, a lot of little things going on here. We got another retirement plan. We're trying to take money out. We're recognizing here, though, if we take out a traditional, you got to pay tax, right? We're taking that distribution. So the tax cometh on this one, okay? We're not trying to defer tax or anything like that. We're going to pay tax. Barley takes $500,000 out. It's going to hit his return. He's going to pay tax on $500,000 from his IRA. Now, if you do it before you're 59 years old, you're going to get hit with a 10% penalty. And that's what they're referring to here at the end. So that's one thing. As long as we're aware of those things that A, Barley's going to pay tax on that income as a regular income tax, and B, he's going to pay a penalty of 10% on the amount taken out, well, then he's fine to go forward. But as long as but you'd want to do that with open eyes, know what you're getting into, okay? But you're going to go out and get a rental. Now all of a sudden we see opportunity. Because if he's getting a rental that he's going to hold out in his, he'll have asset protection, but it's going to hit his personal return. We put in LLCs and things like that, but it's still going to show up on his 1040. We got a lot of things we can do with a rental property, maybe for deduction.
Put on the tax hats, guys. Put on the tax. Yeah, because let's pair this up. If I take cash out of my IRA, that's a taxable event. But if I use those funds to purchase real estate and then get the resulting tax deductions, we can offset the tax.
Exactly.
Sounds pretty good.
And so we have a couple methods to get that when we're in the real estate game. How are we going to make that? We talked a little bit earlier about passive active. What's going on there?
Cost segregation and depreciation is going to be your main players there, but is it active or passive? We have to make sure it's active because then active, as you guys know, is going to offset all other forms of income, including W-2, including taxable retirement distributions, including other income from your other investments.
So you go out and you get a short-term rental. What are you going to do?
Manage it yourself. Cost segregation study.
Materially participate.
Materially participate. Yeah.
Hit that test. One of those 7 branches of material participation that we were talking about earlier, the most common, over 100 hours more than anybody else, or he puts over 500 hours. And yes, his spouse's time counts as well. So that's kind of a, if you will, an easy one, short-term rental. Now, if you get a long-term rental, what do we got going on there?
Same exact concept, but we have a much larger additional test to add, and that's the real estate professional status test that I think we've mentioned a couple times.
Yeah,
next Tuesday.
At least twice.
Rep status test. So yeah, same exact concept there, material participation, but we need the rep status kind of as the prequel, if you will, to get to even be eligible to materially participate in a real estate activity. Because remember, real estate's passive by default, unless we actively materially participate.
Very good.
Yeah, a lot on that one.
Yeah,
but I think we covered that pretty good.
So as long as as long as we get that income producing property, if we make rep stats long-term rental or we materially participate short-term rental, well, we can do a cost seg, get a lot of tax deduction, and that's going to go against that income that we just incurred when Barley took that $500,000 out. Plus, it'll go, it's not going to have any impact on the penalty, but it'll make it less painful.
Right, and I want to mention this to you. So you can take the money out 60 days to put it back. That we just don't really love that, right?
Well,
I don't like it because I get nervous. If you miss that by one day, all that's taxable.
I don't know how we're going to get it back in if we just got an income.
Right, if you use it to purchase a property.
Yeah, I don't think we're going to make that.
Right.
So yeah, that's problematic, I would think.
But just to be, just to be aware, you can take money out of your traditional, put it back in within 60 days. That there's no tax repercussions there. I don't like to mess with that one too much.
Now, if this was a solo, we saw in the earlier question the confusion between solo and IRA about the qualified charitable distribution. What about on this particular question? If we were with the rental, if you want to go back, what if this was a solo? Well, you might be able to take a loan.
Right.
There are limits to it, but that might help, at least give you enough of a loan for down payment on this property.
Right.
But we're not in that genre. We're in IRA, so no loan.
Yep. Can't take a loan there. All right. Any questions we want to hit there?
No, I think they're, in fact, speaking of questions, we got We got Patty, we got
Oh,
Amanda,
no wonder we don't have any questions. We got
we got
Dutch, Jared.
Dana,
Jeez, we got all our tax superstars.
Jared, Marie,
Guys,
Rachel.
you have a bunch of CPAs in the chat right now. Please hit them up with your questions. I mean, we like it if they're related because we can then
Troy.
talk about them, but you got the tax team in the chat right now, guys, in the Q&A. Sorry, not in the chat, in the Q&A. Post your questions in the Q&A there.
And they're wiping them out.
Good work. Thanks, team.
Yep. All right. Is there an annual cap on bonus depreciation related tax deduction? Big question
Kinda.
here. Well, yeah, there's really no limit to how much bonus depreciation one can have. It's going to be 100% bonus depreciation of anything. So that's again the big play. You have a property. It's 27 and a half years. Do a cost segregation. Okay, that's going to break it into pieces: 5-year property, 15-year property, and then you have the 27 and a half year property. Anything under 20 that you've sped up through that cost segregation study is eligible for bonus depreciation. And once you're there, there's no limit to how much you can have and how much loss you can have on it as far as showing up. But what actually happens on your return, there is an overall loss limitation. We call it the excess business loss limitation. So while one can have considerably large amounts of deductions and things like that showing up from their activity, from things like bonus depreciation, when it actually hits your return, if you're filing single, you can deduct up to $313,000. That's the most that you can have as a loss. Double that for married filing joint, we've got $626,000. But one thing that people forget about that excess business loss limitation is that you can pull in all your investment type of income. So that would include if you had an S corporation going on, all your business income. If you had an S corporation, not the W-2 you got from it, but the K-1 you get, the distribution portion. Let's say, again, Barley has a K-1 of $1 million coming in, and maybe he has this property has a massive amount of bonus depreciation. How much can he do? 626? No, he can wipe out that million first, and then an additional 626.
It's the loss that's limited.
Exactly.
Excess business loss. Yeah.
Exactly right.
465J or something like that if you want to look it up. So that's the limitation we have each year. So bonus, you can, if you bought a commercial building or something and took bonus depreciate, that could be, huge amounts of money. Active versus passive would be the first kind of consideration we'd look at there.
Good question.
Obviously, if it's a passive loss, we don't really have these excess business loss, net operating loss considerations. But yeah, no limit on that. And this brings up I just want to touch on this quickly, or we can go into this in more detail if you guys have questions on it. But do we really want to get our taxable income down to zero or even negative? From a practical expense of those low bracket tax dollars are expensive to offset, and they oftentimes don't give us a lot of benefit. It'd be nice if I knew I was going to have 500,000 in income over the next 3 years, I'd really like to spread that deduction out over the next 3 years and eliminate those really expensive top tax bracket dollars, right? We want to eliminate those 37% tax dollars. Me, you, and Warren Buffett, we're all paying the same on our first $12,000, zero, right? We don't need to eliminate that income. So consider that if you're looking at aggressive tax reduction strategies. Usually the goal will just be to get you down into a reasonable tax bracket where you don't feel like you're overpaying.
And that kind of leads us back to where we started with that 179.
Yeah.
Well, what if we don't want to have, I hear what Barley's saying. It makes sense. I have this one large deduction happening, or this amount of deduction happening. Is there some way I could stretch it over 3 years so that it hit all the 37% tax bracket savings?
We love wiping those ones out.
Exactly. Yeah. Even the 35.
Yeah.
That big break between 35 or 32 and 24. Nice.
Yeah.
If you can get into that, you've done your job. Really, you have. Well, no, I want more. Well, okay, that's fine. But if you, with a little tax strategy, you can see how much more you could save if you just have a one-time large event. Yeah. And that would be a play where maybe you do 179 over bonus, perhaps, because you're not trying to create an overall loss, perhaps, would be one thought. And so, again, this is how it all comes together. This is what we do for the tax planning, help you walk through these minefields to make a more informed decision.
And just one more piece on that. I know it's getting in the weeds a little bit, guys, but I know this is what you guys are into. So this is relevant. Bonus depreciation, when we do a cost segregation study, we're segregating out the various asset classes is the language we use here, right? We got 5-year assets, 7-year assets. Of course, the property itself is a 27.5 or 39-year asset, the 4 walls, roof, the foundation, right? When we do a cost segregation study, we're separating out these assets, and we have some kind of opportunity for tax planning there as well. We can deduct all the 5-year assets this year, and then all the 7-year assets next year, and then all the 15-year assets in the following year, for example. So we can spread this out, again, just eliminating those higher tax bracket dollars first and foremost, as long as we can. Getting down to zero is, I mean, I'm sure there's a strategy there, but 9 times out of 10, that's probably not going to be your best play, especially if you're looking for financing, lending, that kind of stuff. Well, I think we got that one pretty good, huh?
Yeah, I
All right.
think we put them to sleep on that one.
Well, but now we're going to talk about cost segregation study in a qualified opportunity zone fund.
So wake them up.
As if we didn't go into the weeds enough, let's go a little bit deeper. No, so, of course, we're talking about more real estate stuff here. Go you read the question for us.
Yeah.
We'll dive in.
Can I do a cost segregation study on a property in a qualified opportunity zone fund? How does this impact the capital gains tax deferral that ends in December 2026?
We better define some terms, huh?
Yep. Opportunity zone fund is simply a concept that the government said, we got areas, or state governments, I should say, we got areas that we want to encourage investment into. So people who have capital gains can go ahead and take those capital gains, invest it, let's say, in real estate in a qualified opportunity zone, where this usually more depressed areas or something like that, get that income flowing in, that capital coming into that area. And we're not going to make you pay tax on that capital gains. This came into play around 2017, 2018 with the new Tax Cut and Jobs Act. It's been extended. However, the Tax Cut and Jobs Act said this plan that we're doing right now for this bill, it's going to end December 31st, 2026. And so that's what we're asking about here. Well, okay, if I had capital gains and I put them in and bought a building and put it into this qualified opportunity zone fund, and I did a cost segregation study, which Barley just walked through, how's that going to happen, impact those capital gains that I must pay at the end of 26?
Right, can it offset those gains?
Exactly.
Oh, yeah.
Well, what's going to happen here is that the couple different things going on is that at the end of December 2026, whatever your capital gains that were deferred, you will pay tax, and you will pay tax on them as the same class as what they were back in 2018, 2019, whenever you put them in. So if they were short-term capital gains, well, they're still short-term capital gains, you'll pay the rate. If it was long-term, well, then you'll pay long-term capital gains rates, whatever it be. But it'll still be capital, and it'll still be short or long. But you will pay them. There's no deferring that or pushing it off or anything like that.
Maybe even for 10 years.
Exactly. You've already gotten that benefit. Exactly right. Now, if we do the cost segregation, this is more related to the ongoing operations at this moment. Okay. And well, now we have a building and we have some income coming in because there's renters and we have operational expenses. One of them for the building being depreciation. Well, we take the cost seg study, speed that up, and that will help offset against the activity, the rental activity of that particular building. But this has nothing to do with those capital gains that you used to put in to the opportunity zone fund.
Right.
So go ahead and do your cost seg study. It will break the property into better pieces, if you will, so that you can get a better deduction now. And depending on whether or not active or passive, yeah, that could help against any income on your return, some of which will be in 2026, December 26, will be that capital gains that you had deferred from way back when you started. But they are related paths you're going down, or excuse me, different paths.
Right, like an indirect kind of offset.
Yeah.
Yeah.
You got the investment with the cost segregation study, which you can do in a building like that. And then you'll have the capital gains that you must pay.
Right.
So that's the idea there. So yes, is the answer. You can. What's the impact? None to the capital gains. You're going to still pay tax. The only thing going on here from a tax, well, not the only thing, but the more interesting thing is cost seg study, a lot of tax savings, potential depreciation recapture if you ever sell that building later on.
Yeah, qualified opportunity zone, that's just the political boundary they draw around the area that defines the physical area. And then the qualified opportunity zone fund, that's the entity you set up. right? Typically a partnership for real estate, maybe a C corp for business, but that's the actual vehicle we use to reinvest the cash and get these good benefits. We're going to talk about that more in just a minute. But there's still a lot of benefits here, right? Especially, and I don't think we're going to go into this in a whole lot of detail right now, but the new bill expanded this to rural, added a bunch of other incentives there. So there's still some play here.
Yeah, no, that's a good point. The bill continues it. It just doesn't, I should say it restarts it in a new phase.
Sure.
Because in 26, we're done.
It's the taxes too.
Yeah, and
Right.
well, what if I heard there's a new one starting January 1st of 2027? Yeah, there is. Well, can I just move? No, you can't do that. You got to pay your taxes. Well, can I? No, pay your taxes. Okay, December 31st, 2026, we pay taxes on those capital gains.
Yep.
Then we can start a new one, January 1st, 2027, a whole new deal with what any capital gains that we have for that.
All right, little more detail on this one. Another great question here. So we just went through, can I do a cost segregation study? We all know what that is. On a property within a qualified opportunity zone in our qualified opportunity zone fund. Now we're asking a little something different here, a 1031 exchange. And this is where we run into the letter of the law, basically kind of gives us our guidance on this.
It gets a little hairy.
Yeah. So can I do a 1031 exchange for a property in a qualified opportunity zone fund, right? The fund that you set up, the partnership or whatever, to avoid the tax due when the deferral ends December 26. We already answered that part. The tax is going to be due December 26 no matter what. It's going to retain the same character as when you originally incurred the tax, short-term, long-term capital gains, whatever it was that you rolled into the fund, that's what you're going to owe tax on in the end of 2026. And that's just the way it is. But let's address this 1031 exchange part. Is there a play here or no?
Yeah, I mean, it's no. 1031 exchange has to be for the exchange of property. So if you invest in one of these funds, you typically are investing with multiple other investors. And that individual, so if Barley goes in there and invests in this fund, he can't do a 1031 on that property because the whole fund owns it, not him. So we've seen this many times with any kind of partnership that a partner can't just go off and do their own 1031 because the building, the real estate that you're trying to, doesn't belong to them. You just own a part of the partnership. It's the partnership that has the building. And the same thing happens, well, what if the fund itself? Well, you said it could be a partnership. Yeah, but even then, it's an investment type that fund can't really 1031 into something else either.
Right.
So the quick answer is no. And why? And it's certainly not going to, as Barley pointed out, it's not going to allow you to defer or avoid any tax on the deferrals that come from 2026. You will pay tax on that. There's no question about that. And the 1031 would only, again, defer on any new capital gains anyway. If you're doing a 1031, it wouldn't be from past ones. So that is why a couple of reasons why it's going to fail here for doing a 1031.
Now, potential problem number one there, that's going to apply across the board. A lot of times these qualified opportunity zone funds, the actual entity doing the investing, you're going to have fractional ownership. You and 1,000 other investors are going to be in there, right? And that would be, you can't do a 1031 exchange in that, even if it wasn't in a qualified opportunity zone fund, right? And you can look at other options there. But even if it was maybe just you and a spouse in the partnership and you had a property, we've already used this tax deferral instrument. And so that's why they're going to then limit that additional deferral mechanism.
You can't defer twice.
Right.
So you have the current deferral going on. A 1031 would be continuing to defer something that's
double
on
deferral dipping.
It would be double deferral dipping. Exactly. Coined it here.
Right. There we go. Double dip deferral.
So,
not allowed.
Yeah, not allowed.
Right.
Good phrase, but we can't use it.
Right. Yeah. Dang.
Yeah.
So no. But great question. And bottom line, the capital gain is due then in 2026. But look into those other, again, if this is something you guys are already in, if this is you guys are already invested in these, you already know about this. Look at the new rules. There's a lot of incentive, and that's the kind of a key buzzword here when we're talking about tax law, right? Incentivization. They're going to say, hey, you get a 35% deduction if you do this. You get a massive tax break if you do this. We definitely want to take a look at those. They may not be, up our alley or in our realm of expertise. But we certainly want to take a look at that. So Qualified Opportunity Zone, go do a little easy research, chat GPT style research, get the generals on that, and then let us know if you have any specific questions. We can definitely go more in the weeds on that, but pretty specific treatment, but incentivized and very powerful potentially as well.
Well, I think that's it.
All right. Well, we had our kick butt tax team answering all our questions.
Exactly.
So we
Again,
got done
thanks
too
to
early.
Amanda, Dana, Dutch,
Yeah, thanks for
Eric,
not leaving us any questions. No, just kidding.
Jared, Marie, Rachel.
Love working
Roy.
with such a great team. It makes me feel like, it's not, I don't have to do everything. We have a
Oh,
great,
we definitely don't do everything.
we have a great
we got
team.
the whole team back there.
Yeah, it's pretty amazing.
Yeah. So we're very fortunate.
How dare you, Troy? We got Troy in the chat too.
Yes.
Yeah. So great work. Thanks to our team for answering all the questions, but we really do appreciate all your questions, and hopefully you got some more questions asked on that, or excuse me, hopefully you got your questions answered on that note. If you become a tax client, you can submit questions to the Platinum portal, written questions, as many as you want. Our Platinum Knowledge Room service, come in 5 days a week, talk to a CPA or an attorney. So we definitely encourage you to do some tax planning, sign up and become a client. Use that QR code, scan, get more information. This is what we love to do. Help you plan for financial success using real estate, small business, etc. All right, guys, wrapping up. They must really want us to promote these YouTube pages. You guys better subscribe. They're obviously wanting you to subscribe there. But make sure you scan the QR code. Just a last chance here. Please join us at the live event here. Got plenty of virtual events too if you can't make the live one, if you don't feel like flying down to Dallas. But scan that, join us live. And again, scan this QR code right now. Talk to us. Let us know where you want to go from here. What's your next business move? We got such a varied team of professionals here. So we mainly focus on real estate, but just within our team here, we've got such a varied amount of experience. So
totally.
Definitely look forward to talking with you guys and working with you. All right, close us out here, Elliot.
Yeah, so if you got questions, please send them in. I'll look them over. Tax Tuesday at andersonadvisors.com.
Well, we're doing this again?
Yeah, well, I guess so. Every 2 weeks.
Every 2 weeks.
Do it again. And visit us at andersonadvisors.com. You see all kinds of stuff up there, events, information about the products or the services that we provide, and just about anything else you want to know about Anderson.
That's right. That's right. So submit your questions. Again, even if you're not a client, submit questions. We'll answer them. We love to go over this stuff live, try to provide whatever fast, fun, educational knowledge we can, because we know this stuff can be overwhelming, confusing, but one step at a time, chip away at it. Take Toby's sage-like advice, pick 1 or 2 things and focus on 1 or 2 tax topics that are relevant to you. Focus on those, get to know those well, apply them, save some money. Next year, pick 2 more and we'll go from there. All right.
I think that's it.
All right, guys. Well, another Tax Tuesday on the books. Thanks for submitting your questions. Please submit questions for our next Tax Tuesday in 2 weeks. We'll see you back here then. Thanks again.